economists have considered various aspects of money, such as the reasons for its existence, changes in its form, and its role in economic growth and development. Income and wealth are often considered synonymous to money, but while they may be expressed in terms of money, they are not the same thing. We therefore need to define money by its use in an exchange economy in terms of its specific functions within the financial system. By specifying precisely what it does, we can distinguish money from all other assets in the financial system. We also need to know how money comes into existence and what causes it to change over time. This requires an analysis of its nature, role, and origin.
After starting this module, you shall be able to understand about the importance of money in an exchange economy and the specific functions performed by money that characterize it and distinguish it from near money assets. You will learn about the various approaches to define money and the basis on which you could classify the different kinds of money that have evolved so far. In a barter economy, the seller of a good would have to locate a buyer who was willing to buy what he wanted to sell in the same quantity and quality. This might waste time and effort. Secondly, the value of each good in the economy would have to be expressed in terms of all the other goods available. Thirdly, future payment contracts would have the difficulty of agreement on the specific commodity to be repaid, its quantity and quality. Fourthly, storing commodities as purchasing power had problems of storage cost and depreciation in value. It is to remove these problems that money came into existence in various forms.
Let us now understand the disadvantage of barter system in detail. The first disadvantage would be a lack of double coincidence of wants. It would be extremely difficult to find someone who wishes to purchase right now exactly what you would like to sell. Thus, exchange under a barter system is costly in terms of the search, time and effort. Barter presents even more serious difficulties when the articles to be exchanged are not of the same value and cannot be divided without loss of value. This makes it an inefficient and cumbersome way to conduct transactions. It raises the transaction costs and holds down the volume of exchange in the economy. The second disadvantage of pure barter is the lack of any common unit in terms of which measure and state the value of goods and services. The value of each good would be expressed in terms of each of the other goods. If there are n goods in the barter economy, there would be n into n minus 1 upon 2 prices. No meaningful accounting system would be possible in such an economy. The third disadvantage of pure barter is the lack of any satisfactory unit in terms of which to write contracts requiring future payments. These future payments would have to be stated in terms of specific goods and services. Though this would be possible, it would lead to three difficulties. One, regarding the quality of the goods and services to be repaid. Two, the parties would often be unable to agree on the specific commodity to be used for repayment. Three, both parties would run the risk that the commodity to be repaid would increase or decrease in value over the duration of the contract. The fourth disadvantage of pure barter, which results from its other shortcomings, is the lack of any method of storing generalized purchasing power. People could store purchasing power for future use only by holding specific commodities or claims against specific commodities. The stored commodity may deteriorate or appreciate in value. Its storage may be costly and it may be difficult to dispose of quickly without loss if its holder wishes to buy something else. All the disadvantages mentioned above make pure barter a highly inefficient means of trade, and to overcome these difficulties, every society invented some kind of money earlier in its development. The development of money has passed through various stages in accordance with time, place and circumstances with the progress of civilization.
Now, for any commodity to serve as money, it should be portable and easy to transport and durable too, so that it does not lose its value over time. Since transactions could be in various sizes, it needs to be divisible into smaller units and at the same time have a recognizable value. Money evolved to remove all the problems of barter system. It performs the primary function of serving as a medium of exchange and a unit of account. It also performs the secondary functions of being a standard of deferred or future payments and a store of value. Let us discuss the first function of money, that is, a medium of exchange. It's a unique function for which money has to be generally acceptable for all transactions including debt. It does not have to be converted into anything before being spent, for which faith and acceptability is important. It can be standardized to have uniformity. Let us now analyze money as a medium of exchange. People save time and energy to buy according to their preferences, leading to transactional efficiency. They get the best bargain or terms in trade, leading to allocational efficiency. They can buy whatever they want, giving them options, thus promoting economic welfare. Every person can sell his goods or services in exchange for money, leading to multilateral trading and specialization and division of labor. The use of money enhances competition, reduces the time and costs associated with the exchange. The second primary function of money is as a unit of account. This means it provides a common denominator to measure the value of goods and services. It determines the exchange price or relative price of each good or service and makes accounting and economic calculations possible, which all require money values. Value of money changes with the price level and hence does not remain constant, unlike physical units. Value of money is inversely related to the price level. Money is the standard in which future or deferred payments like interest, rent, salaries, etc. are stated. It goes with the first two functions. Money is a good standard of deferred payment only if its purchasing power remains constant. Money as a store of value helps in generalizing purchasing power. In the act of purchase and sale of different commodities, people earn money. Since both the acts are not identical, they can be made at different points of time. In other words, income and expenditure are two different activities in a monetary economy and are made at different points of time. As money does not have to be converted into anything before being used, it is liquid and is often used as a store of value. Liquidity of an asset refers to the ease with which it can be converted into a medium of exchange. It is a collection of the four characteristics which include A. Marketability, which implies ready acceptability in exchange for goods and services. B. Predictability, is being able to anticipate its value in exchange. C. Reversibility, is when value in receipts and payments are the same. D. Divisibility, is denominating in the smallest unit. Since money possesses all these characteristics, it is perfectly liquid.
Next, we will discuss the physical properties of money. Here, we need to conceptualize what are the desirable physical properties that any commodity should have to be a good choice to serve as money. It needs to have the following characteristics. 1. Portability. That is, it should have high enough value relative to its weight to make transportation easier, and it should be valuable in small quantities. This was the reason why gold and silver coins as currencies were better compared to rice, horses, cows, etc. in the evolution of money. 2. Durability. That is, it should not deteriorate with time or wear down when handled. 3. Divisibility into fairly small units to facilitate transaction of various sizes. Here we may find that diamonds may be durable and portable, but they are not divisible as compared to gold and silver. 4. Intrinsic or recognizable value to be accepted in transactions. This was possible with gold coins stamped by authority with respect to value or even paper currency.
Now there are different ways in which we can define money. The functional definition of money includes all those things that perform the four functions of money. It is important for money to perform the primary function of a medium of exchange and be generally acceptable. The legal definition of money is defined in purely legal terms, that is, money is what the law states it to be. Law can help a thing to achieve general acceptability by proclaiming it to be money.
Thus, the legal definition of money is that money which is defined in purely legal terms, that is, money is what the law states it to be. Laws can help a thing to achieve general acceptability, proclaiming it to be money. It may grant legal tender powers by ensuring that refusal to accept it would be punishable by law. However, things that are not legally defined as money may still come to be generally acceptable in payment. For example, checkable deposits at banks are a part of money, but they are not legal tender. Legal tender or fiat money serves as money on the fiat or order of the government. It has to be accepted or it cannot be refused in settlement of payments of all kinds. However, small coins are usually limited legal tender for a certain maximum amount, beyond which they cease to be legal tender. Rupees 2 and above currency notes are unlimited legal tender. Demand deposits of banks are fiduciary money and are accepted as money on trust only and are non-legal tender. A payee can legally refuse to accept payment from demand deposits made through a check because it may be dishonored at the issuer's bank. Here there may be insistence on payment in cash.
The narrow definition of money includes in money all those assets that perform the function of money as a medium of exchange. This should include only currency and checkable bank deposits. In the broader definition of money, all those assets are included which may perform the other functions of money except as a medium of exchange. These assets have a high degree of liquidity. Let us now discuss the theoretical and empirical approach to money. In the theoretical approach to the definition of money, we first decide or conceptualize what specific functions or institutional attributes we would like to emphasize. For example, we have the 4 functions of money which we have already discussed. We now aggregate the relevant financial assets which possess those attributes into a measure. Under the empirical approach, we first decide on specific criteria like stability of the demand, function of money, or a high correlation with national income. We then aggregate all those financial assets which, when introduced in certain functions, give the best results in terms of the specified criteria. Amongst the two approaches, theoretical approach is better because it first develops and defines the concept of money and then follows it by proper measurement. Let us now discuss the basis of classification of money. Money can be classified in 3 ways. Firstly, it is based on physical characteristics or material of which money is made of. That is, whether it is in the form of commodity like silver or gold, or in the form of paper like currency notes. Secondly, it is based on the issuer of money in existence, whether it is the government or central bank or private banks. At present, in India, money is either issued by the government or the central bank. The third basis of classification is based on the relationship between the value of money as money and value of money as a commodity. It can be further categorized into 3 parts. First, full-bodied money is money whose face value is equal to the commodity value. That is, its value for monetary purposes is the same as the value for non-monetary purposes. Example, rice, cattle, gold coins. Second, representative full-bodied money is a receipt for full-bodied money, usually on paper and hence no commodity value, but it represents in circulation an amount of metal, say gold, with a commodity value equal to the face value as money. Third, credit money is the money which has a face value greater than the commodity value of the material of which it is made. It circulates purely on the basis of trust commanded by the issuers. It is also known as fiduciary money. The credit money or fiduciary money circulates on the basis of trust commanded by its issuers. This can be of 4 types. First, token coins are coins of small denomination, like 50 paisa or 1 rupee in India. They are a small proportion of money supply. Second, representative token coins are a receipt of token coins and are usually made of paper. Third, Circulating promissory notes are the third kind of credit money. They can be issued by the government. This is called fiat money. It is usually made of paper and is at present not convertible into anything of value except small change. Issued by private banks. This was present initially in the evolution of money, but in the interest of standardization, this right was taken away from them. Issued by the central bank. At present in India, they are issued by the RBI in the form of currency notes of denomination rupees 2 and above. Fourth, checking deposits with banks are payable on demand and transferable by check. They are a major part of money supply. They are acceptable in exchange for goods and services. Now, we will discuss about the evolution of money. We all know that initially we had barter system. To solve the problems of barter system, societies soon evolved a common medium of exchange which was in the form of a commodity like cattle, rice, shells, etc. The problems of portability, durability, divisibility, etc. led to the use of metals like gold or silver for exchange. The problem of short weighing and adulteration led to the coins certified for weight and purity by the issuer. The problem of theft, storage and transportation led to money deposited with goldsmith or bank as they were later called. The bank issued IOUs or bank notes which were accepted as means of payments because of faith in the issuer. Bankers realized that they need not keep 100% of debt in the form of reserves but could hold only a fraction of their debt as reserves. This principle gave power to banks to create money and for banks to act as financial intermediaries between the lenders and borrowers. With advances in computer technology, movement is towards cashless, checkless electronic money. Bitcoins is a virtual alternative currency that uses technology to facilitate instant payments.
We will now understand the evolution of money and changes in the monetary system in details. Such is the importance of money that the breakdown of one monetary system was immediately followed by the development of another system. Primitive economies overcame the inconvenience of barter by the use of uncounted metals like copper, gold and silver as means of exchange because they are generally acceptable in payment. This could be because they possess the above mentioned properties of having high value relative to its weight, durability and portability, etc. However, these metals continued to be used for non-monetary purposes also, and hence metal flowed freely into and out of monetary uses. The use of bullion as money had serious disadvantages of short weighing and adulteration. Coinage solved the problem with an official certification as to the weight and purity of the metal by the issuer, who could be the king. Though an important innovation, coinage still had the disadvantage of danger of theft and storage problems, costs of long distance transportation along with the absence of any interest or return. To remove this problem, people started keeping these coins with a custodian who could be a goldsmith who kept them in a safe box and issued an IOU. Initially, one would have to go to the goldsmith to get the coins to make payments. Later, with faith in the goldsmith, the IOU was given as payments to others and passed several hands. The IOU as a written order authorized that the goldsmith would pay the specified amount of metal to whosoever presented it. This was the birth of the bank and bank notes, a debt or a promise to pay, evidenced by a piece of paper. These paper claims were acceptable because they were believed to be fully backed by the metal. These papers could be transferred and used as payments for goods and services. Initially, the goldsmith or bank held gold to cover all possible redemptions of banknotes and deposits. This was 100% reserve banking because the reserves, that is gold, was equal to the total value of outstanding banknotes and deposits. The only profit that the goldsmith or the bank got was charging a fee for deposits or trade gold for banknotes. At another step in this evolution of money, the person leaving gold or silver with the banker would not receive a paper representing the debt of the banker, but simply a deposit credit evidenced by an entry on the bank books. For making payments, an order could be written on the banker to pay someone else. Thus, these deposit claims came to be used as a means of payment. The emerging bankers soon realized that to meet their promises to pay in a specific demand, they need not hold on to gold and silver equal to 100% of their outstanding debts in the form of deposits and banknotes. Instead, they could hold specific amount to only a fraction of their liabilities. This was the birth of fractional reserve banking. This principle gave banks the power to increase or decrease the total money supply, which was not there when they issued banknotes and deposits only in exchange for an equal value of gold and silver. That was mere substitution of one type of money for another in the hands of the public. With fractional reserve banking, banks held some deposits as reserves in the vault, but loaned out the remainder to people in need of funds. The bank could charge interest on this loan and hence had a second source of revenue in addition to the storage charges assessed on deposits. Here, banks are financial intermediaries because they are accepting deposits and lending those funds to the borrowers. In the evolution of banking, bank deposits emerged as the primary medium of payments. However, the advances in computer technology and the rapid growth in credit and debit card usage, we may be moving to a checkless or cashless society, and electronic money or bitcoins, a virtual or electronic alternative currency that uses technology to facilitate instant payments. The main development is the movement from commodity money such as gold coins to credit money such as checks deposits to electronic money.
Let us now summarize what we have learnt in this module. The disadvantages of the barter system and the corresponding functions of money which remove these inconveniencies. The functions of money as a medium of exchange, unit of account, and as a store of value were analyzed. To perform these functions, money needed to have the properties of durability, divisibility, portability, and recognizability. Money is perfectly liquid as it possesses the qualities of marketability, reversibility, predictability, and divisibility. Functional definition of money includes all assets that perform the functions of money. Legal definition includes all assets which the law states to be money. Narrow definition of money includes those assets which serve as a medium of exchange, particularly along with other functions. Broad definition of money includes assets performing functions other than the medium of exchange called near money. Theoretical approach to the definition of money first conceptualizes and then measures money. Empirical approach first specifies a criteria and then aggregates assets satisfying the criteria. Money evolved from full-bodied to credit money and from 100% reserve banking to fractional reserve banking.